Welcome to Early Age Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20 factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
So today we are going to take a deep dive into Jindal Drilling Industries Ltd. So JDIL is a leading offshore drilling service provider in India with over 3 decades of experience, primarily serving ONGC. The company operates a fleet of rigs tailored for Indian conditions and offers multi-logging and directional drilling services. The revenue breakup are as follows. So 80% of the revenue comes from renting their oil rigs, 19% from directional drilling services, and 1% from mud logging services. So these are the rigs which they have under their control. So they have got 3 rigs which they own and 3 which they have rented. Now coming to their order book. So their order book comes up to 1538 crores, which is around 180 USD in millions. And the breakup or realization is as follows. So in this year, they are expecting to procure around 645 crores from renting their oil rigs in the next 3 quarters, and 581 crores in FY27, 251 in FY28, and 61 crores in FY29, depending on their long-term contracts, total summing it up to 1538 crores in total. So these are their annual highlights. We can see that the company has taken a significant leap in the last 4 or 5 years. So the revenue has more than doubled. And regarding the EBITDA and EBITDA margin, we can see EBITDA has been growing. However, there has been some sort of margin compression, which we can see. Similar has been noticed for the PAT and PAT percentage. PAT has grown really well over the years. However, the PAT margins have declined a bit. However, the company has been generating good EPS without much dilution. Coming to that EBITDA mix, as we discussed regarding the revenue breakups, it's similar with the EBITDA mix as well. So they generated around 216 crores worth of EBITDA from their oil rigs, which generated them steady cash flows, 20 crores from directional drilling, and 1 crores from mud logging, total summing up the EBITDA to 237 crores. Now coming to the industry overview, so the offshore drilling industry is cyclical and closely tied to the global crude oil prices and exploration budgets. So also Saudi Aramco's suspension of 22 oil rigs in 2024 triggered volatility in global rig demand and day rates. However, this demand has been absorbed a bit by the Middle East countries like Kuwait and Qatar, who are creating new demand pools that could absorb that excess rig capacity. However, India relies on imports for over 85% of its crude oil needs, making domestic exploration a strategic necessity. Indian rig rates have softened temporarily due to cancelled tenders, but are expected to recover with ONGC's new plans, and the long-term outlook remains resilient, supported by India's focus on energy security and import substitution. Regarding the con call highlights, so the management mentions that the consolidated profitability is much higher than the standalone due to contribution from owned rigs. Jindal Explorer was dehired in May and will be redeployed in October 2025 post its refurbishment. Also, Jindal Pioneer's acquisition is driving good growth, which they acquired for around $75 million, but it will be redeployed post refurbishment and will not be generating revenue in Q3 and Q4 this year. And despite the rig acquisition, their net cash position has remained healthy at 112 crore, which is a good sign for the business. And the company overall operates 6 rigs, out of which 4 are contracted with ONGC, 1 is contracted overseas, and 1, which is the Explorer, is under refurbishment currently. So the ONGC tendering has been sluggish, impacting the short-term revenue growth visibility. However, management may acquire more rigs if the ONGC tender picks up. Also, the management expects better pricing in the upcoming tenders and considers the low previous ONGC rate an exception. So, what happened was that previously they had rented a rig to ONGC for $40,000 USD per day, which was quite less as compared to the international market standard where they generate around 80 to 90,000 USD per day. The management gave a clarification that because of high competition, they had to settle for lower prices. So that's all about it. Also, the company prefers ONGC for its stability, though it is open for international contracts. And there are no current plans to work with Saudi Aramco due to contract volatility. As we previously read that they have derailed 22 rigs in 2024. So that's why. Also, the company has backup in international deployment plans in case ONGC tenders are still delayed. FY26 revenue is estimated at 925 plus crore with EBITDA guidance at 360 to 380 crores, and FY27 is expected to replicate the similar profitability with upside if rig rates improve. So the management expect that 2027 would be flat. However, this year they would face good growth, and depreciation for FY26 expected to be 38 crores per quarter, and interest cost is expected to decline as debt reduces. Coming to the bull case, so ONGC's aggressive ramp up in FY26-27 drilling plans can drive strong demand for jackup rigs, leading to full utilization of JDIL 6 feet rig. Also, Jindal Pioneer's redeployment in FY27 at a higher than expected rates can boost the company's margins and return ratios. And as the net cash position improves further, it will enable opportunistic rig acquisition potential at depressed valuations for the company. Also, the company has plans on securing international contracts to diversify revenue base beyond ONGC, and the deployment of Jindal Supreme post refurbishment adds incremental revenue this year without major capex. So that's something to look out for. Also, India's policy thrust on import substitution ensures consistent exploration and procurement investment and benefiting the drilling contractors like JDIL. Coming to the bear case scenario, so delay in ONGC tenders or repeated cancellations can lead to underutilization of rigs like Jindal Pioneer, impacting revenue on cash flows. Also, aggressive low-cost bidding by competitors can again distort pricing as it happened last year, keeping day rates below USD 50,000 per day. Also, higher than expected capex or debt-funded rig purchases can drive up leverage and strain liquidity for the company, and increased exposure to group companies can also raise governance issues, which the company has done priorly. And if international expansion misfires, then it will lead to idle rigs or suboptimal margins. Coming to the 20 factor scorecard, so the company were listed in 2006. They don't have any active fundraising history. Also, they've got a very good promoter track record, and the family holds around 64% of the company, which is quite good. So I give them a 5 out of 5 here. Regarding related party transactions, so there are charter hire charges and equipment rental charges, which are both roughly 70 crores from common control entities, which needs to be taken with a pinch of salt. And also there are other minor transactions with related parties, because of which I'm going to give them a 3 out of 5 here. Regarding board independence, so they have got 7 directors, out of which 4 are independent and 2 family members of board. So therefore, 57% independent director representation and 29% family on board. So I'm going to give them a 5 out of 5 here. Regarding CEO or KMP salary, so Mr. Raghav Agarwal, the Raghav Jindal, the managing director, charges around 0.7% of the sales as his salary, and the CEO, Mr. Narayan, charges 0.16% of sales as his salary. So that's not quite high. So I'm going to give them a 5 out of 5 here. Regarding key person resignation, so independent director resigned in 2025. The CEO resigned in 2022 due to personal reasons. Independent director resigned in 2020 due to preoccupation and advancing age. Also, the company secretary and compliance officer resigned in 2023. Because of all these subsequent resignations, I'm going to give them a 3 out of 5 here. Regarding auditor resignation or change, so there hasn't been any, and the current auditor has the tenure till 2027, so I'm going to give them a 5 here. Regarding auditor opinion, it has been unmodified for the past 3 years, and they have got very good CRISIL rating of A plus in long term and A1 in short term. So I'm going to give them a 5 out of 5 here. Regarding regulatory or legal issue, so in 2021 they were involved in two disputes with ONGC, in which 160 crore was received under an interim Supreme Court order, out of which there was pending arbitration and shown as a liability. In a separate 14 crore dispute, 8 crore was settled and 6 crore was written off in Q4 FY24, increasing other expenses for the period. So since ONGC is their primary customer and they have been involved in issues in the past with them, so I'm going to give them 0 out of 5 in regulatory and legal issues. Regarding investor communication and disclosures, so they have all the disclosures available starting from presentation to press releases, con calls, and results. So I'm going to give them a 5 out of 5 here. Regarding business concentration risk, so 98% of the revenue in the last 2 years came from ONGC. So on account of this, I'm going to give them a 0 here, since they're primarily concentrated on only one customer. Regarding CFO by EBITDA, this year it has been 234%, which is quite good. This happened because due to reduction in other working capital items. However, the numbers have been quite volatile over the past few years, because of which I'm going to give them a 3 out of 5 here, pessimistically. Also, regarding revenue growth versus receivables, so revenue growth has been significant and much higher as compared to year-on-year growth in receivables, which is a good news. And receivables as a percentage of revenue have been declining over the past 6-7 years, so that is also a good sign. So because of this, I'm going to give them a 5 here. Regarding DSO, so the inventory turnover ratio is 11, which is quite high. Inventory days are just 32, and the DSO comes up to 87, which is on the higher side. However, it has shown significant improvement in the past few years, because of which I'm going to give them a 5 out of 5 here. Regarding cash conversion cycle, it's on the higher side, it's close to 90, because of which I'm going to give them a 3 out of 5 here. Regarding capex versus revenue, so the company has done significant capex this year of around 100% of revenue, and the fixed asset turnover is 1 and asset turnover is 0.3, which has been constant in the past few years. Also, return on invested capital is 20%, which is much higher as compared to last year, because of which I'm going to give them a 5 out of 5 here. Coming to debt and interest coverage, debt to equity ratio is a 0.1 and interest coverage ratio is 17.2, which is quite high considering the low debt. So I'm going to give them a 5 out of 5 here. Regarding liquidity position, so the quick ratio is 0.3 and so is the current ratio. So that has declined a bit in the past few years. On account of this, I'm going to give them a 3 out of 5 here. Regarding ROCE, ROE and ROA, the numbers have been improved significantly since the last few years, and the numbers are quite good. So I'm going to give them a 5 out of 5 here. Regarding growth consistency, so the revenues are growing at a quite good pace, and so has been for the profitability. Profitability are growing at a very high rate. So on account of this, I'm going to give them a 5 out of 5 here. Now coming to the final score, they scored 41 out of 50 in governance and promoter behavior and 39 out of 50 in financial health, taking their total score to 80 out of 100. Now coming to the valuation analysis.
So on the face of it, the PE looks extremely cheap, like 7.38. I'll tell you the reason why we will not do valuation for this company. One, it's extremely cyclical. If you look at the chart, you can see how cyclical it is. And also if you look at the PE, there were periods the company did not make any profits, then suddenly the PE shot up, then it came to single digit PE, then it shot up. Last 10 years, if you see, there were periods where there's no profit. And the reason is because if you look at the historical trends, it's all linked to global economy and oil prices. It fluctuates from positive like 38 to negative 40%. And last 5 years, as we all know, it was much more stabler environment. Global was doing great, so they were able to command this margin. Maybe why it is trading at a lower P currently is because one, this is trailing 12 months P, and the market might be predicting some demand slowdown with the oil prices coming down, etc. So that could be one of the reason, and it's very futile to make projections for a company like this. The better way to analyze this is trying to get them at the bottom of the cycle. The cycle is somewhere in between, according to me. But then if you are someone who follows macroeconomic in much more closer, oil prices much more closer, then make a judgment call accordingly. So I am not able to make a prediction, so I will not make a prediction here and give any justification whether this price is justified at the current level or not, because I have no idea myself, and I'm not really good with cyclical. So I'll just drop for Jindal Drilling.
If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing, and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching, and we will see you in the next one. Bye-bye.